Good afternoon and welcome to the presentation of TWACS half-year results. Our speakers today are Fabrice Walewski, Managing Partner, and Thierry Schmidt de la Brélie, Managing Director, Administration and Finance. Please note that you can ask your questions through the chat online of this webinar. Fabrice, the floor is yours.
Thank you, Vincent. So welcome to everyone for this presentation. So first, a short summary of our current business model. As you see here, so we are an operating lessor of transportation equipment, 3 standardized assets, containers, rail cars, and river barges. In this industry for 170 years, today 250 employees, 1.2 billion under management, and also a reminder that those markets are very large. You have $124 billion of containers worldwide, it's 54 million. And in fact, today, container became the most standardized assets in transport. Containers today transport 53% of the freight in value in the world. So any cargo transported today, for 53% of it in value is transported in a shipping container. Barges, the barge market is 30 billion. There are 6,000 barges in Europe, 25,000 in the Americas. And for the rail car business, we are in Europe and India, so 700,000 wagons in Europe, 320,000 in India, so it's a 75 billion euro market. So very large markets where we can deploy our strategy. On the next page, you see that, in fact, this business is really at the heart of the real economy and sustainable transport. We saw, of course, in the past years, the development of e-commerce, but there is also a lot of new logistic chains, and therefore a strong need for containers, barges, and freight wagons. On the next page, you see that, in fact, we are a key player in the low carbon transport. Why? When you look at those 3 asset classes and you compare emissions of CO2, you realize that rail cars, when you operate wagons and you do a transport by rail, 9 times less CO2 emissions compared to road. It's enormous. River barges, 3 times less CO2 emissions compared to road. And for containers, it is so efficient, and you can do long-term distance because of those economies of scales, savings. It's in fact a very low number, 7 grams of CO2 per ton kilometer. And here you have the indications for comparison with road, 137 grams of CO2 per ton kilometer. TWACS is so a lessor, very active in sustainable transport. And here we can summarize our achievements in 24, in the first half of the year. In fact, we did confirm our good ratings, mainly with EcoVadis, with a gold medal. In fact, today, so we are part of the top 5% of most sustainable companies across all business sectors. So very happy of this result. We did also try to grow the number of financing with which are green financing or sustainable financing, and today 74% of the group financing are sustainable, have a sustainable nature. We did start also working with investors who love or like or really prefer to invest in infrastructure related to transport, but related also to the green transport. And we are very happy to welcome EIB, the European Investment Bank, positioning itself as a climate bank, as a partner, as an investor. And they did invest, again, beginning of this year through a fund which is named CETEF, who is one of our main investors today, co-investing with us. On the next page, you see here a very good summary of our activities. So those 3 activities are managed through a dedicated subsidiary. You have TWACS Rail, number 2 in Europe for the intermodal wagons, number 2 in India also 616 million euros of assets under management, 70% owned, 30% managed on behalf of third-party investors. As a reminder, Touax Rail is 51% owned by Touax, and 49% is owned by an infrastructure fund known in the Netherlands named DIF, and they have been acquired in this first semester by CVC Partners. So today we have a partner in the rail business with more than 100 billion under management. We are very happy to have them with us to expand the business. In the river barge business, it's Touax River Barges, 100% owned by the group, #1 in Europe and South America, with around 100 million under management, and then containers with 543 million euros under management. We are #1 in Europe and #3 in the world for the management of containers on behalf of third parties. In total, 1.2 billion under management, and as you saw, it's roughly a little bit more than 50% owned and a bit less than 50% managed on behalf of third parties. Here it's a very good summary of the origin of our income. We are an operating lessor. It means that we rent equipment to more than 2,000 customers today. So we obtained from leasing transactions on our owned assets. So again, owned assets is a little bit more than 50% of the assets we manage today. So we generated 44 million euros of revenues. Then any operating lessor also has to sell the assets at the end of their leasing life. And we recorded under that, for that business, 28 million euros of sale revenues. We also have some activities in trading. We also trade assets. Then we have the management activities. And for that, we generated in the first half of this year, 7.9 million euros of revenues. It's an additional contribution to the leasing business model of owning assets and renting the assets. So it is added to the, it's a net contribution to the EBITDA. Who are our customers? Again, around 2,000 customers. Here we name only a few, but all those names, you have to know that we have a relationship exceeding 20 years or 30 years. So it's a very long-term relationship with all of them. For freight wagons, who are the users? But it's the rail, state-owned freight railways. So like Deutsche Bahn, DB, or SNCF in France, or Switzerland, CFF, or Rail Cargo Austria. But you also have big industrial groups who love at the moment to do a model shift from road to rail to reduce their CO2 emissions, like Tata Steel, but we have also Volkswagen or other companies. And then you have private operators like Freightliner, Lineas, or Hupac. For river barges, it's also big logistic companies like Imperial Logistics, who are huge, or Rhenus in Germany on the Rhine River. But then you have also industrial groups like ArcelorMittal, for example, or Cemex. And for containers, typically for more than 90% of the business, this is a very international shipping line, who became conglomerates in logistics like CMA CGM or MSC or Maersk Line. So strengths of our business model is summarized here. The activity, again, is really an investment company investing in highly standardized assets and mobile equipment. They are very long life assets, 30 to 50 years. They have very low obsolescence risks because they are highly standardized, so we can always find a new lessees or potential buyers for them. And also, it's a long-term leasing business model. You will see later on, our average contract durations are between 3 and 10 years. The levels, we in fact try to be very well diversified. So ownership versus management, but also good diversification geographically, and also a good diversification in asset types to have a recurrent revenue and cash flows. And by the way, this strategy, so meaning long-term leasing contract with those standardized equipment, means that on January 1st, 2024, we already have 79% of our leasing revenue of the previous year committed. So 79% of our revenues is really recurrent. Now I turn to Thierry for the presentation of our results.
Thank you, Fabrice. So profitability and fleet development. Let's go on the income statement. For the result at 30th June 2024, we have a good level of operating profitability. The restated revenue of activities are up by 1.4 million. Restated revenue of activity. Why restated? Because in the asset management for IFRS, we do record gross revenues and net revenues, which is not really understandable. So we then restate the gross revenue as net, and here we just present net revenues for asset management. So restated revenue from activities up by 1.4 million. We can see this impact also in the EBITDA, which is up by 1.1 million. The net income group share is coming down by 1.2 million. Quick explanation of what are the impact below the EBITDA. We have a current operating income which is decreasing by 0.6 million. It comes from the depreciation amortization. We'll see this later. There is also 0.7 million of non-recurring operating income and expenses. In fact, we'll see this later also that there was higher non-recurring income in 2023 than in 2024. And we have higher financial expenses by 1.1 million, but this has been compensated by less income tax expenses and minority interest. So if we look in details in the next page, we can see the breakdown here of the restated revenue from activities. So the own equipment leasing activity, the first line, small increase. In fact, it's quite stable because some leasing revenues has been depreciated in operating expense. The own equipment sales activity, we can see here quite a decrease, not big decrease, but some decrease, where in fact there has been less sales in containers than before. That has been compensated a little bit by more sales of modular buildings. So we'll see this and we'll detail this later. In terms of management, there has been a very good activity in management this first semester with very good volume, and we are up here in management activities. So all of this goes into EBITDA. We can see in depreciation and amortization some increase. In fact, we have invested and then we have a little bit more depreciation. We do invest this year, and we do have invested to replace all fleet. We do not have invested to grow because with the current situation of the economy, we consider that we can have a slower pace to invest. Other operating income and expenses. So here are these non-recurring items. You can have also or look at the line below financial result, which is a net income from discontinued operation. So in 2024, 1.9 million of non-recurring compared to 2.6 million in 2023. So 2023, in fact, we do have repurchased some minority interest that had a positive result of 3.6 million, but we had a litigation in the US that cost us 1 million. So that's why we had the 2.6 million non-recurring. In fact, this litigation, we had a favorable settlement in 2024, and we have been able to recover 0.4 million. This is what we see in other operating income expense. And in net income from discontinued operation, in fact, we had an additional payment from the sale of the modular building activity that we have done in 2017. So you know that when we do sell activity, there is a guarantees that can last long. It's now finished, and it finished by a positive amount and a complement price payment of 1.5 million. So this impact the operating income. The financial result, you can see an increase by 1 million of interest. In fact, this is essentially an increase in interest rate. There is a small increase in terms of debt volume, but the major part is really the increase of interest rate. if we compare again H1 2023 to H1 2024, we know that, or we've seen that yesterday, that there is some cut in interest rate in the US dollar, not in the pound, the sterling, but then maybe this will come to decrease for the next months. Consolidated net income then decrease a little bit, and we have here the group share and the minority interest. So if we want to see in details this by division, what happens if we look at the different activities, and we can see that the diversification that mentioned Fabrice just earlier is good for the group, as we've seen an increase in the performance in the freight rail cars and in the river barges, where there have been a decrease in containers and others. Others, just a word, it's a modular building, will not come back later. So in fact, in terms of activity of revenues volume, it has been a little bit higher than the first half of 2023, but with lower margin. In fact, we do anticipate an increase of the margin during the second half of 2024, where it was a decrease in margin in the second half of 2023. We have a very good order book, a strong pipeline, so we do expect to have an increase in that activity compared to last year for the full year. For the different transportation, if we dive into them now, so for the freight rail cars, so the fleet of the freight rail cars has been increased a little bit. Just to remember that in freight rail cars, we do operate in two geography. One is Europe with the UK. The other one is India. The economy are quite, the activity is quite different in those two geographies. India is at a very good level and very high level, very good performance, where in Europe we've seen a performance lower, and especially in some type of rail cars, such as intermodal rail cars, that are where the utilization rate are decreasing a little bit. So we do have continue to invest in that activity, and especially in India. The weighted average age of the own fleet is 13 years, is very young compared to the economic lifespan of 30 to 50 years, or compared to the rail cars we can see in Europe, which is almost in average 30 years. So very young fleet with a very good average lease term, which is 4.1 years. So good visibility in that activity. The average utilization rate has decreased a little bit, and especially in Europe and some type of rail cars. So in terms of financial, in the next page, the impact here, it's a positive impact. In fact, despite the lower average utilization rate of 86%, so it's 2 points lower than last semester. The own activity has been up because we do have invested, as I said, and especially in India. We do have also a good volume and a strong increase in management activity. So this 1.2 million of increase in revenues finish at a 2.1 increase in EBITDA, because we have also lower operating expenses for this first half semester. If we look now at the river barges, we do operate river barging in Europe and in America, South America, North America, where it's a balanced portfolio between these two geographies. 59 barges in Europe, where there is 48 in Americas. Again, the weighted average age fleet of own fleet is very young, 14 years here in river barges, where the economic lifespan is almost the same as the rail cars, 30 to 50 years. Average utilization rate very high, 96%. We are now at 100%. Everything is leased with an average lease term of 5 years. So it's a good visibility again in that activity in terms of leasing revenues. In terms of financial, What is the impact of that? In fact, we can see a small increase in revenues, where there has been a big increase in EBITDA. So it comes from, in fact, lower chartering, 1.2 million less chartering in revenues, but chartering means less operating expenses by 1 million, and then a good volume of management activity, 1.6 million. And I said, Fabrice, this is a net direct in EBITDA. So that's why the EBITDA has been up by 1.4 million euro for that activities. Now the containers activity. So we do manage 330,000 containers, about 30% owned, 70% on behalf of third parties. Again, we have here a very young fleet with a weighted average age of 6 years, with a good visibility. So 6 years compared to, again, as containers, as river barges or rail cars, an economic lifespan of almost 35 years, 15 years in maritime, 20 years in land. We do operate during the maritime life after we sell the assets, where the residual value is between $1,000 to $1,400, depending if it's 20 foot, 40 foot. The average price of our containers is really competitive. It's $1,429 per CU, cost equivalent unit, in terms of net book value, so quite low. Average utilization rate is good, also almost 97%, with a very long average lease term of 6.6 years, and a very good proportion of long-term lease. 83% of the leases are long-term, from 3 to 10 years. So good visibility in that activity in terms of leasing. And I insist in terms of leasing, because in that activity, and we'll see in the financial now, we do also have another activity, which is sales, because we want to make more profit in terms of sales. And here we have seen during the first half of 2024, decrease in the volume of sales of own equipment, decreased by 2.8 million. And this decrease explained, in fact, the decrease in the revenues from activities and the decrease in EBITDA in that activity. I would say it's temporary. The volume are up again for that activity in terms of trading. Asset management, as we've seen on the transportation activity, there has been a good activity and volume in asset management. And as explained by Fabrice, it's additional contribution to revenues and growth. It helps us also to continue to provide assets and equipment to our customers. So the investors are strategy to invest in those assets. In fact, it's a diversification strategy in relation to financial market. So they have a small pocket. They want to invest in other assets, and here it's real assets, so tangible assets, steel boxes, which are natural hedge against inflation. It provides recurring returns because we do sign long-term contract. It's long life tangible real assets. We've seen 30 to 50 years in sustainable transport. So it helps also to invest in green, I would say, for sustainable development and to reduce the CO2 emission. The contract we do sign with the investors are very long term. So we do sign very long term, our long-term contract with our customer, but here it's even longer with our partners, our investor, because it's 12 to 15 years. We do not guarantee a minimum return. We do not guarantee any revenues. In fact, the investor, they take the risk of ownership. But we do align our interest because our assets are pooled with the assets we manage by investors. So if we look at the different type of investors in the next page, in fact, it's very diversified. We do work with insurance companies, pension funds, family offices, finance companies, bank, and also infrastructure funds. We do work today with 38 different investors. They invest in or directly in the assets and purchase the assets, or through funds. We do operate, or we are the operating partner of a SICAV SIF in Luxembourg, which is a real asset income fund. This fund has invested 170 million already of assets in two separate funds. One is euro and one is US dollar. The outlook and the highlight for 2024, again, good volume for the first half, 55 million globally in freight rail cars, river barges, and containers. For the forecast, we have also good pipeline and good interest for investors for almost 72 million of new program with investors. So to conclude on that, good activity and profitability for the first half. So if we look at the now the balance sheet and the cash flow statement, which is quite important because we do lease assets, so we do have assets and we do own assets and we do need to finance those assets. Here you can see the economical balance sheet where we present in assets all the equipment, the river barges, the rail cars, and the containers that are in non-current asset or in inventories. 493 million of assets. In that asset, there is only 9 million of goodwill and intangible. A very small amount of goodwill, some intangible, and we'll see later because we do invest in digital also to develop our productivity. This is financed by the equity, shareholders' equity, minority interest, and group shares equity. Net debt, the working capital is a resource, is not something that has to be financed by the debt. So the debt is financing only tangible assets. We do see here an increase in debt because there has been a decrease in the resource of working capital. In fact, this comes from some cutoff in end of last year. But you can see that the debt is financing only assets, and it's a very good loan to value. We'll see this just after. So in terms of debts, those debts in the next page are a part without recourse to Touax SCA. So we have about 75% of debts that are non-recourse debt, 243 million, and 92 million, which has recourse debt. Most of the recourse debt are debt, corporate debt on Touax SCA. So for a total of 336 million euro of debt. The finance sources of that debt, 11% is the debt capital markets, 12% is corporate debt, bank debt, corporate bank debt, but 77% is asset-backed financing. For sure, we do have assets, so we do asset-backed financing, and all these asset-backed financing mostly are non-recourse against Touax SCA. The average rate by end of June of the gross debt is 5.72%. It was 5.69% in December 23. I do not have in my mind the number for June 23, but it was lower, and we've seen the impact in the financial interest. And you can see here the different rate per currencies with a high rate in US dollar currency, 6.58. So we are happy to see the cut yesterday from the Fed. Next page, the credit profile. So we do have debt, standard credit profile for the group. We do refinance those debt step by step. year by year. 2024, we've done a term out of a revolver line facility in the container activity and renew the revolver facility. And then we will come to renew all that facility with the term loan and the revolver in 2026. So 2026 will be the containers refinancing. Just before next year, 2025, is the railcar division financing. So we'll have to refinance all the railcar division with the term loan and the revolvers. And 2027 will be the corporate debt, 72 million. We do have here a club deal loan to refinance at the level of 35 million and a Euro PP at 38 million. So to be sure to be able to refinance, which is important, is to have a good loan to value. Again, the value of the group and the value is the assets. These assets keep a very high value. And in fact, the value is coming up again with the inflation. So the loan to value today is 60%, quite low considering the youngest, that the fleet is quite young. One thing important also is the interest coverage ratio, for sure, because we need to look at the cash if we are able to pay the debt and to pay the interest. High level of ICR, interest coverage ratio, at 2.67. We can see decrease from last year, and this is because, in fact, the interest rates are coming up, but now they are coming down, so we'll have maybe better interest coverage ratio. To finish that financial presentation, let's speak about a little bit about the cash. Here you can see the cash flow statement, where we do present the operating flow, the investment flows, and the financing flows. One thing important is that in operating flows, we do record, because of IFRS, all the operating flows, so all that comes from the activity, like the EBITDA, but also all the purchase of equipment. So if we do purchase equipment, if we do invest in equipment, this is recorded in operating flows and not in investment flows. Investment flows is only intangibles, mostly for our activity. So operating flows are always positive. So we can see here a small increase in operating flows, change in operating working capital, 0 in H1. As I said, last year there has been a cutoff end of June, so we can see this 11 million positive. In terms of purchase of assets, so here we have a decision or to purchase or to stop the purchase. So it's a good lever for the company to say, okay, we keep our cash or we can invest. And it's not, I would say, the market that decide. We have decided in the first half to continue to invest, but at a slower pace, and just to replace the older equipment. So this, at the end, give us a net operating flows positive of 5 million. If we look at the financing flows, so investment flows, some in investment in digital software to continue to be productive and have a higher productivity. For financing flows, here it includes the interest paid, the dividend to minority shareholders, but also the change in financial debt. So just say that the change in financial debt, when you look at the balance sheet, was 11 million, 10 million. Here we can see only 8 million in change in financial debt. Why? In fact, because the balance sheet is recorded according to closing exchange rate, and this cash flow statement is done according to the average exchange rate. So the difference here, it's because of this exchange rate. So just to conclude on that financial activity, good activity, very good resilience, thanks to the diversification we have of the group, and thanks to the syndication and asset management.
Thank you, Thierry. let's go to the now business outlook and strategy. So first focus on the freight railcar division. The target has been increased early this year to go to now 16,000 wagons. So we have 13,000 wagons at the moment. And so it's to increase the fleet by around 20% in the next 3 to 5 years. Why that? When you look at the market, in fact, there is definitely a green agenda, as we say. There's a model shift in many countries towards rail, indeed, because of the lower CO2 emissions. So good prospects. Of course, when you look at the numbers, it's at the moment less for Europe, but when you look at the emerging markets like India, it's huge. So 7% growth GDP, and in fact, their model shift should increase, from a bit less than 30% to 45%. So 45% of any transport will be done by rail in this country in the next few years. What is interesting to note also that because of liberalization, the private sector, including Touax, other lessors, and also our LPs, so financial investors, we do finance today 75% of any acquisition of rail cars. This is very important when we know that just 20 years ago, the states in general were investing in more than 80% of any new investments. So it's, our market share grow definitely in that. Negative, however, is Europe. So first half of the year, as you know, because of the Ukrainian war, inflation, high cost of energy did impact the industries, especially in Germany. And there are some lower traffic, especially for container transport by rail. However, in other segments, including the automobile, indeed, that market is quite growing. Our ambition to conclude for the rail, so again, go to 16,000 wagons, 75% in Europe, 25% in India today, but in emerging countries. So to have, again, to keep a good diversification between, countries like mature countries and emerging countries. Continue to develop our services, diversification, our fleet. And when I talk about services, as you know now, almost all our wagons are equipped with GPS devices, and we start to offer to our clients a lot of services, including predictive maintenance, geofencing, how to locate, every minute their wagons, etc., etc. We continue to implement also CIPs, continuous improvement process, to reach operational excellence for our customers. The next business segment we do a focus on is river barges. Here the target is to go from 107 barges to 150 barges in the next 3 to 5 years. Why? A little bit the same than rail. There's a very positive market for everything related to sustainable transport. We have a lot of big customers, big industrial customers. They want to reduce their CO2 emissions. Again, a reminder, 30% of CO2 emissions are coming from transport in the world. So for any company like Solvay, Volkswagen, Tata Steel, and others, if they want to reduce their CO2 emissions, they have to have a special strategy in transport. And we help them to be equipped with transportation assets reaching their goals. So that's very positive, and we will continue to invest. And so again, our ambition, we have placed orders in Europe. So it will be organic growth, and it is currently, new barges to be delivered on the Seine River, new barges to be delivered on the Rhine River, especially for transport like biomass or grain or aggregates. And we have 4 additional barges today under discussion, including electric, autonomous, self-propelled barges to be completely clean and to be able to cross cities. On the next page, on the container activity, so the target is really to continue growing the activity. When you look at the market, in fact, it's quite positive. We were not that sure. There were, as you remember, a peak of the activity after the COVID. 21, 22 were record years for the shipping line, for our customers, with a lot of demand. Then came the normalization of the market in 22, second half, and 23, and early 24. But what I can confirm today is that the market changed completely in the mid of the first semester, and because of the huge disruption in logistics, again with the Gaza war, the fact that the ships have to go are rerouted to the south of South Africa in order to reach Europe. It adds a lot of days to the normal trips, and therefore there is additional requirement in equipment. So we saw a big surge in demand. We give here one number: resumption in demand for new containers in 24. There should be more than 6 million containers built in 24, maybe even 6.5 million. It will be again, therefore, a good year for investments, and we are restarting to do investment, in fact, at the moment, to just supply our customers. Utilization rate, as you saw, for the market is quite high. Yeah? We reach almost 97%. This is also what is seen on the market. So again, our strategy is to continue developing this activity. There's something we add to the normal business. This is that activity to rent on a short-term basis, maximum 6 months, new containers, and then sell them. Normally, we rent for 15 years, even 20 years, and when we sell second-hand containers. But here, we call it trading of one voyage containers, one trip container. That activity is today 12,000 per year, and we want to double it to 25,000 per year, which would be an additional $30 million of revenues. Okay, so in summary, in terms of outlook and strategy, when you look at the key 5 positive points we can see around us. First, we see that it is really resilient business models based on long-term contracts, so bringing recurrent cash flows. As I said, the green transport really support our businesses. E-commerce need for a new infrastructure, intermodal logistics definitely help us. The trend of our customers to outsource definitely continues, especially in markets where it was liberalized recently, like rail. And again, we have also the support of great LPs and great investors who are co-investing alongside us, and therefore will help us to increase our AUM, asset under management. Again, because of the fact that investing in those real assets is a natural protection against inflation and a good investment. So our strategy on a group level is to try to increase the value of to do a 10% performance per annum. So it can be through an increase of the net assets, or it can be a 10% return on equity, including dividend we pay. But that's really the goal, and to do that on a very recurrent basis. We will also, as I said, develop other activities alongside leasing, like trading new or used equipment, and also management on behalf of third parties. And we will continue using, again, as I said, CIP, so continuous improvement program, Lean Six Sigma methodologies to exceed, the average levels of customer and employee satisfactions. Now I can finalize this presentation with just look on the performance of the share. So as a shareholder, I would say, we look at a few KPIs, but the main one we look internally is book value per share. This is really, what we follow very carefully, and of course, return on equity. So book value per share, there's an increase around 6-7% in the first half of the year, from 10.97 euros to 11.7 euros. This is in line with our strategy, as I said. However, another explanation on the drop in 23, it was, because of the acquisition of a minority shareholding in our modular building activity. And when we did purchase back the shares of a minority shareholders, there were past losses. We had to, take that into account in our equity. So it was really the reason. That acquisition was the reason. But if not, the net book value per share is increasing as planned. Return on equity is not mentioned here, but for your information is if we annualize it, the first half year results, it's a 9.8% return, and we target 10. So we are at the moment 9.8% return on equity. It's 82 million euros of equity group share. When you look at our balance sheet, you have to eliminate the minority shareholders. Dividend, we want to continue paying a dividend. We restarted to pay it in 23. We paid in July 24, 12 cents. So it was an increase of 20%, and we want to continue to do it. Thank you again for attending this presentation, and we are very happy now to answer any question you may have.
Thank you, Fabrice. Currently, there are no questions in the chat of this webinar. Waiting for a little bit, but no specific question. Very clear.
Okay, so thank you again. So I know that for this English presentation, most of the questions are arriving after the call. So don't hesitate to do it as usual. You can send emails and we will answer with pleasure.
Thank you very much.
Thank you. Thank you to everyone. Bye-bye.
Bye.
Cheers.